Good morning, I'm Benjamin Sullivan, and welcome to Market Monday for February 9th, 2026. After the breather we got a couple weeks ago, it's right back into the action. Let's jump in. If you felt the volatility last week, you weren't alone. A historic rotation played out in real time as investors pulled money from mega-cap technology stocks and moved it into more defensive sectors tied to the real economy. Think industrials, energy, healthcare, and financials. The shift was triggered by unexpected increases to AI spending plans unveiled during Amazon and Google's earnings calls. Google guided 2026 capital expenditures toward $175 to $185 billion, while Amazon followed with roughly $200 billion. Investors are no longer content with promises. They want proof that these AI investments are more efficient than returning capital to shareholders through buybacks or dividends. Meanwhile, the equal weight S&P 500 outperformed the market cap weighted index, signaling that the rally is broadening to other sectors. The Russell 2000 small cap index is up over 3% this year, while the S&P 500 has slipped into negative territory. Precious metals and crypto had their own roller coaster. Gold briefly traded above $5,500 an ounce before crashing 11% in a single session, while silver fell from $120 an ounce all the way down to $80 an ounce, suffering its worst day since 1980. Bitcoin broke below $65,000, its lowest level in over a year. As we mentioned a few weeks ago, speculation can cause rapid price increases, and last week taught us that sword cuts both ways. The US government entered another partial shutdown last week. Sound familiar? This was the second in roughly 5 months. This time, however, Congress passed a funding bill to end it relatively quickly, but the disruption was enough to delay economic data once again. The January jobs report, originally scheduled for last Friday, has been pushed to Wednesday of this week, and the consumer price index has been moved to Friday. On the labor front, what data we did get painted a sobering picture. The Challenger jobs report showed employers announced over 108,000 layoffs in January. That's the highest for the month since 2009. Job openings fell sharply to 6.5 million, and ADP reported private payrolls grew by just 22,000. It's worth noting that roughly 40% of the layoff announcements came from just two companies, Amazon and UPS. So context matters. Still, these are numbers worth watching closely, as labor is one half of the Fed's dual mandate. So what's the takeaway? Market leadership often changes gradually, other times, all at once. The past few years of index gains have been driven by the Magnificent Seven. So far this year, it seems the Mag 7 has passed the baton to the other 493 stocks in the S&P 500. Value stocks are outpacing growth. International markets outperformed the US for the first time in 15 years in 2025. And sectors that were left behind are finding favor once again. When leadership shifts, it can feel uncomfortable. Headlines about record layoffs, crashing metals, and tech sell-offs can tempt us into making reactive decisions. But history has shown us, time and again, that the investors who stay disciplined and diversified are the ones who come out ahead. These transitions are exactly why we build portfolios the way we do. We don't stay concentrated in last year's winners. We position ourselves across asset classes to capture opportunities wherever or whenever they emerge. Well, that's all we have for you today. As always, thank you for watching this week's edition of Market Monday. We look forward to seeing you next week.